Hello and welcome to our interview series where we bring you face to face with the experts who manage your money. Today, joining me and my colleague Chirag is Manish Banthia, CIO Fixed Income at ICICI Prudential AMC. Welcome, Manish.
Hi, how are you? Thank you for this interview.
Good to have you here. Now, to begin with, you chose fixed income over equities after completing your CA. So, what drew you to this field and how has it shaped your career so far?
Back in 2005 when I joined ICICI Prudential, I did not join in investments. In fact, I joined in the product development function. And I always had this inclination when I was doing MBA at Delhi. I always had this inclination that I wanted to move to finance, and investments is something which was a preference for me. Between debt and equity, it was, I think, more accidental that I got an opportunity to move to fixed income. And that is where I think the journey started. But as I progressed within the fixed income function, I realized that, you know, um, and now that I also do some part of equity as well, I realized that fixed income brings a lot more depth in terms of macro thinking, and which I think, and also when you do, credit research, you take credit papers, the risk reward that you have to look into, it's very different from, what you do in equity. And therefore, I would say that it's been a great journey for me in fixed income for the last 20 years, a great learning experience, so to say.
You've spent around 2 decades at ICICI Prudential Mutual Funds witnessing landmark events like global financial crisis and credit crisis. What are the biggest lessons you have learned from navigating these turbulent times?
So, 20 years has been very long, and there have been a lot of learnings in these 20 years. But if I have to briefly define my key learnings and the challenges, I think what one underappreciates when they do credit as a asset class is that credit always has a tail risk, and the problem with tail risk is that you can't price it properly because how do you price a tail risk? It's just a probability of something multiplied by the impact of it. Now, when these are tail risks, the probability which you define is very, very small. So therefore, the impact overall is not very great when you take that risk. The challenge is that the probability of these tail risks may be low, but when that happens, it happens. And then the probability surfaces as a very big probability. Therefore, the impact becomes very large. So there's something which one should always remember at in their mind when they, do something which relates to yielding assets or credit, that you have to be mindful of the credit and the tail risks. The second is that, what I have learned is that risk emanates when, people actually don't look at risks or people have overconfidence. And this happens in every cycle. When does a risk become systemic? It becomes systemic when large number of investors, ignore risk and try to, incorporate in their investment thesis without looking at risks. For example, in 2018 in the credit markets, what we saw was that the entire market, wanted to be very aggressive on risk, and because nothing had happened in the corporate credit for the last, so many years, the interpretation was that these events are very low probability, and therefore, system was very confident that some of these things will not happen. Now, when you have very high confidence, the problem is that you start to take more risk than you usually do. And if everybody starts to do the same thing, the risk at the system level increases.
Okay.
And which is where the tail risks normally play out. So they actually come at a point where confidence is very high and your expectation of them playing out is very low. And which is why they're so very different when, compared to a normal risk, which you normally look at. This third is that in terms of credit, when you're buying something, it is very important that you have a good research at the point at which you are getting into a particular paper. And the reason is that there are times when some exits are possible. There are times when exits are not possible. And there are so many times you've seen in the market that once you get into something, to exit becomes very challenging. So I think the third is that the research has to be very strong, and it has to be done at the time of investment, not once you've invested then you start to research, given that prices have become volatile. So some of these things are very important. I think markets are cyclical. That is my broad understanding after 20 years, and you will find that different points of time, the cycle will display itself in different ways. At various points of time, people will feel, very depressed, and absolutely no risk taking will happen. And there will be periods of time when people will become very buoyant in terms of their thought process, and there will be exuberance all around. If you understand this, then I think your investment processes can be tweaked in a way which can help you to ride through these market cycles. And this is something which I think is one of the greatest learnings for me. Sometimes what happens is people start to define markets differently. For example, currently people are saying that the flows in the market is very high, and therefore that is how people define the market. That if flows remain high, then where's the risk in the market? The problem is that at the market peak, always flows have been the highest. Doesn't mean that peaks have never formed, right? So every time, the markets start to scale higher, possibly at some point of time with the fundamentals behind the market, possibly at certain points of time without the fundamentals behind the market, your antenna on risk has to go up. It cannot go down. And which is why, at high prices, I think risks always increase in the market, and low prices, risk always comes down. Whereas a normal thinking in the market is that when prices start to fall, people start to assess risk. I think it's the other way around. When prices are going up, risk in the markets go up. And when prices are coming down, risk in the market actually comes down.
If you could share with us, what's your core investment philosophy in fixed income and how has it evolved over the years?
So, as far as interest rates are concerned, again, the cyclicality part of it is something which we believe in the core, that interest rates are instruments which are, in line with how economic or the business cycles, pan out. And the role of monetary policy is to support the business cycle or to restrict the business cycle at various points on the business cycle, and which is the basic tenet or the basic philosophy on which we run our fixed income portfolios, which effectively means that we have to assess where are we in the domestic business cycle, where are we in terms of the international cycles, and therefore, given where the interest rates are, how do we create portfolios in that environment? That's the basic philosophy with which we work as far as interest rates is concerned. As far as credit is concerned, the basic philosophy is very simple, and that we've followed in ICICI for a very long period of time, which is safety, liquidity, and then returns. And effectively, if you understand what it effectively means, is that if you have done your research right, if you're taking the right judgments in terms of investment decisions, you have been safe enough, you have created enough liquidity in the portfolios over the medium term, your returns will reflect the kind of processes you have run. So, in the medium term, returns are reflection of the first two, that is the safety and the liquidity aspect of the credit risk. I think I find myself as a value investor at the core of my heart, right? So I think that's basically a construct of a particular person, and you can't change the construct. That is what I've come to a conclusion. You'll find people, who think differently, people who are focused on growth. Then there are people who are focused on value, and then there are people who will generally be focused on quality. So these are the kind of differentiations you have within the internal construct of an individual. Now that construct is not very different when it comes to fixed income as well, because in the fixed income as well, you will find people who chase momentum. You will find people who chase value. And when I say value, what effectively it means is that you look at different parts of the market which kind of seem disassociated with the fair values, and you pick those parts where you think that there's better risk reward, and that is value investing for me, from a fixed income perspective. So for example, in 2021-22, we bought a lot of floating rate bonds, and the idea over there was that the fair value, and the actual market value, they're far dissociated with each other. Um, these bonds were issued at a period of time when government fiscal was very high in 21 because of COVID, and the spreads which are available on these bonds were 140 to 160 basis points. Now, in the past, we have seen that these bonds have never been issued with spreads more than 40 to 60 or 70 basis points. So this kind of within our processes highlighted that these bonds were deep value, and which is a reason why we took large exposures in some of these bonds. And since then, these spreads have come down from 140, 160 basis points to 70 basis points now, and we've made returns based on these compression of spreads. Similarly, there have been periods before where we've taken additional tier one bonds of large private sector and public sector banks, where generally there was expectation. I mean, and I'm saying in 2020 and before that as well, when the pricing of these bonds were relatively very attractive. In the last 1 or 2 years, the pricing of these bonds have become quite compressed. The spreads are very narrow, and we're kind of avoiding some of these from our exposures. So the basic thought process for us is that when we approach a particular segment in the market, our basic analysis is: are we getting enough in terms of making returns compared to what the underlying risks are? And if that is true, then it helps us to take investment in these segments. The second part of it is sizing. I think that's very important, and that is something which I think people miss out. Then if you're looking at something which is deep value, and if you assess your risk well, I think sizing becomes very important, because that is where most of the returns are made. So the second part of it is how much do you size when you assess a particular value in a particular asset class. So if you can do these two things correctly, then I think over a period of time that should reflect in terms of alpha on your portfolios. But doesn't mean that these strategies work at all points of time.
Yeah.
There will always be markets where markets would be in momentum, and I've always found myself kind of struggling in periods where markets is in huge momentum, because that effectively means that most of the value in the market is already played out. Market is at extreme valuations, and therefore for a person who normally seeks value, it becomes challenging to create effective portfolios. So I understand that as a part of my overall thinking and architecture. So therefore, I'm fine with underperforming at those points of time, because that doesn't suit my personality. But that is okay. I think the challenge for India over the last 2 years has been that most of the markets have become a flow-driven market, and one of the reasons for that is we had a very easy BOP situation, balance of payment situation. Current account deficits had reduced over the last 2 years, and the foreign flows were very large. But for the last 3 to 6 months, that was the basic nature of the markets. Equity saw a lot of inflow, both from the domestic investors and foreign investors, and fixed income also saw a lot of inflows from foreign investors, given that index inclusion started in India last year. So when you have a situation when generally you have very high savings and flows are very large, it starts to reflect in all asset classes. So we had a very typical period last year where all asset classes did well at the same time. Equity did well, bonds did well, gold did well, silver did well. I mean, I have not seen a period where all asset classes have delivered at the same time. Normally in my construct, you will have a period of time where when equities are doing well, normally bonds will not do as much, because that means growth is very good, and the Reserve Bank of India would normally be tightening monetary policy at that point of time. Or you will have a period where growth is slow and equity is under delivering, but duration in bonds as a strategy does very well. Last year, what happened was both asset classes did well, and therefore, for me to highlight a particular asset class at this point of time in India is, a little challenging, given the fact that nothing I think is very cheap at this point of time. But having said that, the good thing is macros are, quite good in India. And effectively, that means that you will only get average valuation right now in India. I don't think you will get a cheap valuation. So your investment philosophy has to reflect, good macros, and you should change strategies when you start to see macros deteriorating, because then the markets will start to see more expensive. In good macros, you will have to, take that in your underlying framework and say that if the macros are good, what is a fair value, and therefore work accordingly. Um, but I think if somebody moves, beyond India, I think emerging markets globally look very cheap at this point of time from the same framework, and I think emerging market equities have underperformed in the last 10 to 15 years. And I think from a risk reward perspective, it seems exceedingly attractive from a contra or a value strategy from that perspective.
When it comes to assessing credit quality, what factors do you focus on while evaluating the issuer's creditworthiness?
I think two things are important in credit. One is willingness, the second is ability. And I think both are equally important to assess. When you start to look at willingness, if it effectively means that what is the promoter quality and what is the governance standards of a particular company you are lending to. And I think that becomes very critical because we've seen in the past, companies where everything looked good, but the governance standards were not good. And then when governance standards are not great, some of the things which you have not been able to assess initially, they start to, impact you later. So therefore, number one is assessment of promoter and the governance standards of the company. And then, when you have done that, ability is the second thing which you need to assess. And when you say ability, it effectively means that you will have to assess, the company, the sector, what kind of, market cycle. If it's a cyclical sector, what kind of market cycle the sector is in. If it's a non-cyclical sector, then, you have various, ways of looking at the balance sheet. I think as far as fixed income is concerned, cash flow is something which is very important, and we give a lot of importance to cash flow because that is something which ultimately leads to repayment of obligations. And balance sheet assessment is very important. And equity, what I've seen is most of the people concentrate more on profit and loss account, whereas in fixed income, the assessment starts from the balance sheet. So I think if you combine the two, look at the P&L and then look at the balance sheet as well, it makes you a more comprehensive, assessment. So which is where I think some of these things which I've learned in fixed income, and then I've started to also, kind of look at some parts of equity as well. The assessment becomes complete only with when you combine both the P&L and the balance sheet together.
Right now, you are a co-fund manager of around 25 debt schemes. So how do you distribute responsibilities and ensure alignment across such a diverse portfolio?
So, I now have a responsibility of being the CIO as well, and which is where I think I have realized that there has to be a system of delegation, there has to be a system of process, there has to be a system of review. And this process of delegation review is something which helps me to manage a broader scale of work. Um, over a period of time, what we've done is, within the organization itself, we've created a lot of processes around what we do in terms of investment, in terms of portfolio management. And these processes not only help in terms of an individual fund manager to, create individual portfolios, but at the same time, it helps me as a, as a CIO and as a, co-fund manager in so many funds to review the strategy, to discuss with each co-fund manager what is the broad aspects of each fund and how different strategies have to be run in different funds. So I think one, the team is very important, and we have a very good team of people who have spent long years with us. Some of these people are homegrown. They have started their careers at ICICI Prudential, and this has helped me to align my general thought process with my team members. And since we've worked with each other for a long period of time, effectively it has helped me to manage a larger scale. Understanding of each individual is far better, and therefore ability to manage scale therefore becomes easier.
I was looking at few of the debt schemes at the fund house and found a shorter average maturity compared to the industry peers. Was your early call on interest rate cut factors in this, and how are you adjusting the strategy now?
So again, I'll take you back to our basic, framework in terms of how we uh, look at the interest rates. As I said, our basic framework and philosophy depends on the understanding the business cycle. And our assessment of business cycle has been that India has been growing at a mid cycle. And when you are in a mid cycle or an expansionary cycle, what effectively it means is that interest rates in that period normally remains stable. You don't get very large hikes or cuts unless the economy starts to overheat or the economy starts to slow down. And therefore, from that perspective, our thought process has been that in this part of the cycle, we have to one trade the duration, not be aggressively positioned on either side of the duration, and number two, also take benefit of carry in terms of accrual from the credit papers. So we've aligned our strategy in those lines. And the second thing which I talked about is there are periods where I have underperformed, and last 1 year has been a period where the fixed income has seen a lot of flows, and the 30-year bonds, particularly the long duration segment, the yields have compressed a lot. The spreads between a 10-year or a 5-year bond with the 30-year bond went down to as low as 10 basis points or lower than that. Now, when I assess a particular cycle, I've seen that these 30-year bonds have traded at a spread of as high as 100 basis points and as low as 0 basis points. Starting points of spreads last year was not very high. It was just a 25-30 basis points of stress spreads, which compressed down to 10 basis points. So effectively, the market was in momentum given the fact that there was so much of flows in the market, and the rhetoric in the market has always been that demand supply has been very supportive for the market, given that flows has been very high. I think my assessment is that most of these demand supply factors have now been factored into the market. And at the same time, I'm not seeing economy turn, away from the mid cycle at this point of time. So therefore, I would want to be in the mid duration segment. I would not want to be at the extreme high end of the duration, though that extreme high end of the duration has performed well over the last 1 year, and spreads are at their all time or in the cyclical lows. I do not want to necessarily chase those spreads. I don't see risk reward in that segment, so I'm staying away from that segment. It has hurt us a little in the last 1 year, but I think over a period of time, um, you know, uh, given the way in which we assess spreads and invest, I think over medium term, some of these things will get factored out, and possibly the performance will come back.
Right. Now, Manish, could you walk us through your credit risk assessment process for corporate bonds?
So I'll first help you understand the organization structure that we work with, which is very different from some of the other organizations which I've observed. We have a separate credit risk department, and the reason this credit risk department was created was for the fact that normally I've seen that when the CIO who's responsible for performance is also responsible for risk, there generally is a situation where conflict of interest comes in, and to make sure that the conflict of interest issue doesn't arise, we have created a separate department, and this department reports directly to the CEO. So my credit risk head has a direct reporting to the CEO, not to the CIO, and which is the reason why he is independent in terms of taking independent credit risk decisions. And the way we do that is, if we have a transaction, when the investment team has a transaction that they want to invest in, the credit risk team does their individual research. The investment team also does their research, and ultimately, it is the credit risk department who's responsible to onboard a particular credit within the fund house. Now, since they are not obligated to look at the performance of the fund, they only look at the risk part of it, and if they're comfortable, then they will onboard the credit. The second is that we have a structure where there's a multiple approval authority in terms of approval of a particular credit, and that depends on the level of risk that we assign to a particular credit. So there are credits where it's just the credit risk manager and the CIO and the fund manager who have to approve a particular credit, then there are cases where even the board gets involved, and the board also investment committee and the board also gets involved, and they have to approve certain credits. So it's a tierization structure that we have created, and that kind of also is the second way in which the risk is assessed in a more systemic way. Apart from that, as I said, what from a portfolio manager, what is important is the assessment and the pricing of it. So when a portfolio manager has to onboard a particular credit in his portfolio, he has to look at both the risk and the kind of pricing he's getting, and he has to assess that the pricing is attractive to him given his assessment of risk. And the fourth is the credit risk department itself. I think we have a fairly large credit risk department where the assessment is being done in a more in-depth way when we onboard a particular credit, and also review is done periodically basis the underlying risk. So it's a complete wholesome process which we follow, and I think some of these processes has helped us so far to avoid some of the risks in the market which have played out in the last 10 years. And we continue to believe that the organization structure and the processes would continue to support us in the future as well.
Right. Another thing, with the inflation remaining persistent and the US markets continuing to adjust rates, how are you approaching duration management in this challenging macroeconomic environment?
So I think the first question is simpler. The second question is a little difficult. Why I say the first question is simple is because I think, as I said, we are in a mid-cycle. What does that mean? It effectively means that growth is growing closer to potential. Inflation is also not either accelerating or decelerating. So largely, we've seen that inflation has remained in the band of 4 to 6%, and that's a comfortable zone for Reserve Bank of India. Of late, what the inflation has gone up is largely due to the vegetable prices, which effectively are very seasonal, and we already seen some part of vegetable prices cool off. So I'm not too worried about that high inflation. But the second part of the question is very interesting at this juncture and also a little difficult to answer. The reason is that we have US already in a very late cycle, which effectively means that their unemployment level is very low, and they are having policies which are expansionary at this point. With the Trump presidential candidature and his complete red sweep in both the Congress and the Senate, effectively what it means is that the policies which Trump talks about, and these are policies which they're not coherent. At certain points of time, they're saying that they would need to cut taxes. They're saying that they will have to put tariffs. They are saying that immigration is something which they don't like, and therefore there will be deportation of people. What if it effectively means is that there will be a lot of impact on the consumers in US, and imposing tariffs on consumer goods would effectively mean that what the consumers used to enjoy as the benefits of globalization for a long period of time in US, the same will not be available to them. Cost of consumption will go up. Secondly, when you have already constrained labor supply, and then you talk about deportation of people, effectively it will make the labor market even tighter, and that should put pressure on the wages as well. So we have an economy which is already running hot. The current account deficit is at 3.5%, fiscal deficit is at 7%, and the policies all point towards making them even worse rather than consolidate. At the same time, what they're saying is that they want to make sure that the inflation is lower. They want to make sure that fiscal deficits are lower. I'm confused. I don't know how that can be achieved with these policies. So I think we are bracing for an interesting time as far as US is concerned, and I think there will be a lot of volatility in the US markets, and that should make investing interesting going ahead. We've had a boring time for the last 2 3 years. I think we'll be bracing for an interesting time ahead.
Manish, any duration curve offering attractive spreads at this point of time?
I think the 1 and 2 year corporate bond curve looks attractive. The reason is that if you look at the AAA corporate bond curve, it's an inverted curve. Your 10-year corporate bond trades at 715, 720, whereas the 1 year, 2 year point trades at 750, 55. So, the way I look at it is if we have, one or two rate cuts, I mean, I'm saying if, but if we have one or two rate cuts, it benefits the short end of the curve more than the long end of the curve, and therefore 1 or 2 year, which gives you a good carry relatively at this point of time at 750, 55, and at the same time if we get some rate cuts, some benefit of capital appreciation as well, I think that is where the value in the market is. Otherwise, I think the longer end duration of the corporate bond curve is very expensive at this point of time. In fact, if I look at the spreads on the corporate bonds against GSEC as well, they are at their almost all-time lows. So that's an avoidable segment to me, whereas a 1 year, 2 year is where I think there's decent value.
Okay.
Also, the
And
corporate bit,
yeah,
where I think is interesting right now. The reason is that uh, the credit risk is relatively lower right now from corporate balance sheet perspective. We've seen that most of the corporates have seen decent earnings growth in the last 2 3 years, and they've been able to raise equity well. So the leverage in the balance sheets has gone down substantially. So I think on a more selective basis, when we find something which has a decent yield uh, in the AA segment or in the single A segment, we find that pretty attractive. So that is the other area where I think there's value in the market.
how do you strike a right balance between risk and reward when selecting instruments in your portfolio?
So one of the easier ways to look at historical spreads. I think history is something which resonates almost always, if not repeats. So and there are reasons why spreads are large and why spreads are low. And it is the same as saying that PE valuation in equity at certain point of time, when you look at historical levels, you'll say that PE valuations are either very high or very low. Price to book valuations are either very high or very low. The same in fixed income, we look at spreads. Number two is also assessment of the underlying macro and the reasons why spreads are high. So sometimes there's cyclicality, which and most of the times I think it is cyclicality which leads to higher spreads. But at certain points of time, it also is structural. For example, in case of credit, sometimes it's not cyclical, but it is structural. And at that point of time, you have to be very careful because if it's a structural deterioration in a particular credit, and then at that point of time, if you use the same lens of spread and say that spreads are high and I should enter into a particular credit, I think you should be very careful. So it depends on asset to asset, but generally I think from a more top down view, spreads is something which comes handy to us.
Okay. Another thing is, how central is macroeconomic analysis to your fixed income strategy? Could you share how you integrate economic forecast into your portfolio decisions?
I think that's a central tenet of our thought process. Our entire team, when we work on managing portfolios, the main thought process which runs in everybody's mind is macros, and we think that everything else is a factor of it. So if you can broadly understand the direction of the macros, you can get your portfolio decisions right, and that requires a lot of understanding and work in terms of data interpretation, both at the domestic level and as well as at the global level. So we do a lot of these internal debates and discussions where we try to assess what are the domestic macro views for most of the team members, what are the global macro views. We debate with external people as well, because we find that a lot of good work is done externally as well. So it doesn't mean that we adopt the external work, but it helps us as a platform to debate when the views are different with most of these external experts. And the third is that we have our own in-house economist, and I think she has a very important role in our entire fixed income function. And she does two things. One is she does a general analysis of economy in terms of fast moving variables, in terms of different variables, how these different variables are playing out. The second is these are more medium term shifts which she kind of analyzes, and that also helps us to understand the medium term shifts which are happening within the broad domestic and the global markets. So I think, to answer in short, it's the macros are the basic base for thinking for us.
Okay, now for investors looking for versatile debt schemes that act as all-weather options, which ones would you recommend, and what would be the reason for that?
So we have a scheme called All Seasons Bond Fund. The idea for that scheme is that it has flexibility to take durations as low as 1 year, as high as 10 years or more. It has the flexibility to take sovereign credits. It has the flexibility to get into AAA segment, AA segment. So the flexibility is such that it has the ability to move, in different segments at different parts of the market cycle. Now we understand that flexibility also means that risks also becomes higher, and which is why we use a very process-oriented approach when we approach this fund. Uh, Whether it is duration or whether is it asset allocation, all is a product of the processes that we run, and therefore it's a very process-oriented fund from that perspective. We have an in-house, model which is very core to our macro research, and the output of that is what is the output for the duration of the fund. And the spreads which I've talked about, these spreads help us to move from one asset class to other in the fixed income space.
In today's uncertain market environment, how should investors structure their asset allocation between fixed income and other asset classes?
I think given our assessment that we are still in a mid cycle, I think what our expectation is that if valuations become very expensive in any asset class, then you would get a below normal return. If valuations are at par in a mid cycle, normally I've seen that India is a 7% real growth economy. Add to that a 4% or 5% of inflation, that becomes a 11% kind of a normal growth, right? In this environment, if you have an asset class like equity or fixed income which is fairly valued, I think the expected return of fixed income should be around 8%, expected return on equity should be around 11-12%. But if your assessment is that valuations are expensive, then you deduct so much out of the valuations and then look at the returns. So from an asset allocation perspective, you have to change your allocations to both fixed income and equity given where valuations are. And we have internally some of the funds which we run on some of these strategies where we toggle around between fixed income, equity, and we also invest in gold and silver in some of our products. And the underlying thought process over there is also relative valuation among these asset classes, and also look at market cycles as well. So basis that, if you're asking me, I think at this point of time, with some correction in equity, I think given that equity was richly valued sometimes back, some correction has already happened. Fixed income, again, some corrections happened, but I think both these asset classes are uh, you know kind of where you will get an average return. I don't expect supernormal returns in any asset class. For somebody to get a supernormal return, the assets have to become cheap, which is not the case. So I'm expecting average returns from assets in India at this point of time.
Okay, now Manish, you're listed as a co-fund manager of the ICICI Pro Business Cycle Fund, which is a pure equity fund, along with Anish and Lalit. So, what role do you play here in managing this fund, and how do you basically contribute to its strategy? If you could explain that to us.
So it's a very interesting part of my journey of investment. And back in 2021, Naren, who was our CIO, he asked me whether I would want to run this new fund, business cycle fund that we were coming up with. And the idea was that business cycle fund is a top-down fund, and the approach for this fund is to look at the broad macros, to look at the business cycle, which is very similar to what we do in fixed income, where we look at the business cycle itself, where are we, what is our assessment. And the idea for business cycle fund is to look at that both on a global and the domestic scale, and then look at sectors, which sectors would benefit in each of the business cycles. So over this last 3 years, if you look at the business cycle fund, we've invested in different sectors at different points of time. We've moved away from some of the sectors completely. We've got into different sectors at different points of time. So it's a very top-down approach fund, where my contribution is that my area of strength is macros. My area of strength is to understand the sectoral part of it, and that is what I bring in this fund. It's a very interesting fund where every week we have meeting between all of us, where we discuss very different from a normal equity approach, where you normally look at only stocks and then start discussing about the stocks. We discuss about the top trends, and we discuss about various sectors, what sectors would benefit. Once we have ideated about which sectors would benefit, then we start to discuss about the stocks within the sectors. So that's where I tend to contribute, for this fund. I find it very interesting, and I think it's a very different way of investing, in equities. Sometimes what happens is you like a particular sector, but you don't know which stocks you have to invest in. So, for example, real estate was one sector back in 2021-22. Sector did not do well for a long period of time. Then you wanted to enter the sector, and because the sector had not done well, to get good companies to invest in was a challenge, because most of the companies were in the early stage of reconstruction. So, but if you have a view that you have to invest in a particular sector, what you can do is you can do a very broad-based index type of investing in, sometimes under such circumstances as well. And when you do that, you kind of benefit out of the sectoral turn rather than a stock turn itself. So these are some of the themes we've used, in business cycle.
So are you also looking into the stock specific calls of this fund?
No, I do get into that as well. There are certain sectors which I kind of understand better. I kind of add value in some of those sectors. Like banks is something which is where it's generally related to the fixed income markets, the interest rates. So that is, and credit as well. So some of the sectors like that, I also look at commodities part of the business for multi-asset fund. So commodities is another sector which kind of I add value to that. And over a period of time, when you start to look at stocks, sometimes you do get some stock ideas as well. But broadly, if you ask me, my area of contribution is more top down in that fund.
Before we wrap up this chat, what are the key risks in the credit environment that you are currently monitoring? How are you preparing your funds to navigate these challenges?
I think one thing which one needs to be careful about as far as credit is concerned is that over the last several years we've only seen retail credit expand in India. When I say retail credit, the unsecured retail credit, and uh, there are places where some of the delinquencies have started to go up. Like microfinance is one area where, when you look at the Q2 results, most of the MFI companies have given much higher gross NPAs compared to the last quarter. And clearly, it is a red flag. RBI has been saying over the last 1 year that unsecured retail is something where there could be some stress, and they have tightened governance conditions, credit conditions in that area. So I think within the credit as well, some of these NBFCs which lend to unsecured retail is where we are mindful towards. But from a broad corporate credit point of view, we find that broad corporate credit is very comfortable at this point of time, and therefore the challenge right now for us is to be very careful when we monitor the NBFCs and particularly the NBFCs which are into unsecured lending at this juncture.
All right. Well, thank you, Manish. It's time for us to wrap up this chat. Thank you for taking the time for this lovely interaction.
Thank you so much. It was all my pleasure.
Thank you, Manish.